Good afternoon. It's 3 p.m. Saturday. It's a really good weather in Iowa, Des Moines. I'll tell you that if you are in the state south, in the south side of the country, the summertime, you should buy a cottage in Des Moines, Iowa area. It's a pleasant summer. It's really nice weather. Today, our topic is about this OBBBA Act. This one, we have talked a lot about it. The prior knowledge, what we have on the website, and you can ignore that because right now you want to follow what is the most current, right? And we are trying to separate the sessions for you so you get the overall knowledge, by different parts. So today we're focused on individual. When we talk about individual, it is the 1040 taxes you file, right? 1040. And it is the 1041, the estate side of things. But we are focusing on our client group. So majority of our clients are small, medium-sized business owners. So what we have done here for you is to summarize the relevant knowledge that you need to know. And this includes the tax preparers, small accounting firms out there. If you are doing this kind of service and you just want to know what's changed, it is not exactly require you to calculate, right? You would get your tax software updated. And if you file your own taxes yourself, you got your TurboTax updated. So a lot of these knowledges, I just want you to know the spirit of it. Then all the calculation falls through. If it is effective for 2025, by the time you file 2025 taxes, it will already be there for you. That is where the industry exists, right? Interpreting the tax law and tax code and making that into a software as an end user, whether you are a CPA firm or you are a small tax outlet or even individual, and you just make sure that you purchase 2025 years tax software to really understand how the calculation goes. But if you don't know this in general, sometimes you're overlooking things, or your software wasn't done such a good job to remind you, hey, you have a limitation here. Are you sure you can take all of the deduction? So this is where the skills comes in, and the smarter tax preparer or the more professional CPA firms and companies would come in because they understand the softwares is also can have a limitation. They may not interpret or implement that thoroughly for you, right? So you know how the software, there are software for dummies, right? So they start from what's your name, what's your social security number, and are you in business or not? You answer yes or no, they will bring up different forms for you, right? That's the knowledge, that's the kind of the approach TurboTax is taking. It is really for dummies, and you're not dummy, but what they're trying to do is they're trying to interpret those requirements into layman language for you so you actually can file your taxes right. So our goal in this channel, you know how we put out all these knowledge, it is really for you to do it yourself, and you know the buzzword, and you are going to look to that items when you run your taxes, or you are going to be such a big shot when you talk to your preparers, goes, don't forget this and don't forget that, and that will help your preparers to do it right. So let's get going. So my focus here, number one, you can do it yourself with what I tell you. Number two, and it is focused on small, medium-sized business, there are also rules and regulations introduced by this act which I did not include because it's so far away from small, medium-sized business owners. I do not want you to spend any time to even get into it. If I tell you alternative minimum tax calculation changed, Why would you even care? Because that whole set of calculation is behind your real tax form. It has its rules. It has also had changes this year by this OBBBA Act, but let's not even waste our time on that, right? So what I want to focus on is what's on the surface, what you must know and what you're going to be touching on when you do your personal tax return. So let's get going. So with with today's topic, finding my mouse. Still not finding my mouse. All right, I got it. Now, of course, this is our website, communitycpa.com. I encourage you to visit our website to get to know us more. And this is YouTube channel. YouTube channel has been established in 2020. So we have been on there for 5 years, a lot of knowledge accumulated inside. Some of those knowledge are not time sensitive. It is always going to be there. But some of those content, like those OBBBA, and if you hear me talking about this yesterday and you hear me talking about this today, what I said today would be what you are going with. Because we also in the process of updating our knowledge and understanding the interpretations from Journal of Accountancy, from Thomson Reuters, from IRS, what they posted. So we are also absorbing those knowledges to make sure that what we say to you is understandable and is correct. All right, with that, and I will say this is just a list of our firm. What I want to impress you with is we have 5 branches, okay, across 4 different states. I also have these 2 books on Amazon. If you want to know me more, these books start the chapters of my personal experience. So it goes from my personal experience all the way to my client, so you will know me more when you read those books. All right, no responsibility disclaimer. In this day and age, it's so important you know that this is a free knowledge and just take it with grain of salt and don't apply knowledges just because you heard internet was saying that, right? So like example I give you, our clients looking for small business deduction of $20,000 and I can find it nowhere, so I ask them to send me information. Where did you see that $20,000 deduction? Then it turned out to be Australian taxes, is not even US. But internet has no boundaries, right? So you really want to make sure that you look at the timing, you look at the geographical locations, and you understand what the AI is telling you. All right, so individual income tax rate. You know, I have about 20 slides related to all of these things. So the general structure is I tell you what happened before, then I tell you what is today. So that way you know what OBBBA is doing. So on the individual tax rate, before the Job Act, you know what Job Act is, right? And here in my slides is TCIA, that's Job Act. That one it marked the time before 2018. That's where President Trump 1.0, when he became president, and he passed TCGA. But before that, our individual tax rate, the highest rate is 39.6%. Okay, so related to the personal tax rate, the trust and estate also have the rate that kind of locked steps with the individual tax rate. The high is 39.6%. So let's say if you die and after the exemption amount, then you will pay 39.6, and if you meet certain amount threshold. So with that said, that was the rate before President Trump became president. Then he became president, he introduced TCGA, this is Job Act. This Job Act set certain things to expire by this year, the end of 2025. The rate has already been this way for us. So if you're not into these kind of things, and you know that you filed taxes already, right? In 2018, 19, 20, 21, 22, 23, and even when President Biden came in and he did not make any changes to TCJA, so it went on to today. So you already familiar with the rate. That rate is set to expire now by the end of 2025. So this OBBBA Act, this new one, this one big, beautiful bill act, it is actually made it permanent. So it says that make TCJA tax rate reduction and the bracket changes. TCJA also changed the bracket, so making the rate, for example, if the rate is between this $50,000 and you apply this rate, is actually extended the bracket. So made all of that permanent. And the TCJA also eliminated spousal, the married file jointly penalty, right? We call that marriage penalty. It fixed that. So that continues. And of course, making that permanent means it will no longer expire like how 2025 is. So we are going to have the same tax rate we are familiar with and going forward. So 2026 come, we're not going to fall back to pre-Job Act time, right? That's that one. So just a reassuring, and the tax rate you see and you experience so far is going to be the same. Our tax software producers will breathe a relief because they don't have to change a lot of things in that regard. Standard deductions. Standard deduction at the Job Act time, they had increased the standard deduction amount. So the basic standard deduction amount were $24,000 for joint filers, for husband and wife filers. And of course that including the survival spouse, right, for 2 years. So $18,000 for the head of household, $12,000 for single, and the married file separately. You see how that $12,000 is 2 times of become $24,000. That's a married file jointly. You see how that standard deduction eliminated the marriage penalty, right? That's what Job Act did. And it also modified the rule for inflation indexing of the statutory base standard deduction, because these amounts are actually the government adjusting based on they call the CPI, and I'm not a statistician. I don't understand how they calculate that, but they refer to a tax year which is 2017. They use 2017 data to adjust the inflation. So for 2025, standard deduction is right now is $30,000 married file jointly, $15,000 if you are filing separately. So that is set to expire in 2025, but 2025 didn't change. Ladies and gentlemen, you know that we still go with the Job Act. So it's the $30,000 married file jointly and $15,000 single, and so you know that we're still follow Job Act. But the new act increased the basic standard deduction statutory amount for tax year beginning of 2025. Beginning of 2025. Okay, I'm going to reverse what I said earlier. So the Job Act said that 2025 is $30,000. But this new one big beautiful bill said that we're gonna give a raise. So they did $31,500 for joint filer and the surviving spouse, $23,625 for head of household, and $15,750, which is double of the $31,500 for married file separately or single. So you see, basically, in spirit, they adjusted that Job Act number by increasing by about 1,500. And the other significant adjustment, which is going to beneficial for the future, is that they modify the inflation adjustment for the standard deduction, the calculation is not based on 2017. It is going to be based on 2024. So my general understanding of that means that it will reflect much more real inflation than what we were projecting way ahead, way in the past. So 2026, there will be a new number come out for us, and it will be more than 31,500 because inflation is there. But the calculation of that is gonna be based. 2024, not 2017. So expecting bigger adjustment basically. Then charitable contribution is also something that experience changes here. So let's understand this. So in the past, the contribution can only be deducted if the taxpayer do itemized deduction, right? If you have a contribution, you have a Schedule A, you put that in there. 60% of adjusted gross income, your AGI. So let's say your W-2 is 50,000. Let's say your W-2 50,000, your spouse is another 50,000. So you have $100,000 in your W-2. You don't have any other income, so your AGI is 100,000. That is your adjusted gross income. 60% of your adjusted gross income limitation means that your cash contribution to the public charity, and you cannot deduct more than $60,000. You can do anything under $60,000. You cannot deduct above that because your 60% of AGI limitation applies. So that is what was before. So let's hear what is now, okay? And what is now is effective next year, not 2025. So you just hear it, and if you say, Ying, I don't want to hear anything 2026, I'm already confused for 2025, then this section, it doesn't change. You still go with the prior law, right? So basically what the new act, OBBBA Act, did is to create a 0.5% AGI floor for itemizer. What did that do is, let's say, you donate 60% of your $100,000. So you donate 60,000. And what they want you to do is they don't want you to deduct 60,000. They say that 0.5% of your AGI, the floor, is not deductible. So what is 0.5% of 100,000? That's $500. So that means you can only deduct 60,000 minus $500. Does that make sense? So that floor is like floor. You don't really, that is the basic, and you have to, exclude that into your deduction. Permanently extend 60% AGI limitation means that 60 set in stone and no changes. So the old law allow you to deduct 60, but the new law allows you to deduct less than 60,000. Is 60,000 minus 500. Makes sense, right? All right. So the permanently allow non-itemizer to deduct up to 2,000. So I want to show you the next slides. That is what that is. So what they're saying is that we allow charitable donations stay outside of Schedule A. So you're going to get a donation on the first page, which maximum is 2,000 for a married couple, 1,000 for single filer. So under the current law, there's no such a thing, right? But you do remember during the COVID time, there was a little short period or maybe a year that you can donate. They allow you to deduct before the AGI. So basically, this new OBBBA Act provides that non-itemizer, if you just use standard deduction and you didn't have a lot of charitable donation, you can claim a charitable deduction not in excess of 1,000 per person, per filer, the individual filer, or 2,000 for the joint return. To qualify this non-itemizer charitable deduction contribution must be in cash. must be to the public charity. What is public charity? 501c3 is public charity, right? So if you want to know, okay, is this charity public charity? You can go onto IRS website and just look up whether this charity is a public charity. The non-itemized itemized charitable deduction is a below the line deduction, deduct from AGI. So it's actually affecting your tax rate. So if you are $2,000, over that tax bracket, that $2,000 will save a lot of taxes for you. So it is before your taxable income is calculated, so it is very helpful. And the provision applies to tax year beginning 2026. So it's not this year, it's not 2025, 2026. So, we are in 2025, and you may want to consider, if you have a donation you want to do, and you may want to consider move that into 2026 and deduct that before the Schedule A. Miscellaneous itemized deduction terminated, educator expenses accepted. So this is another changes for this new, the new beautiful act. Basically, if you recall, before Job Act, we could deduct 2% of miscellaneous itemized deduction, right? Job-related deduction come over there, and people do use that to deduct. But that is eliminated by Job Act, so that elimination is permanent. So no more, and forget about that, even that term, so it doesn't exist. But other than permanently suspend the miscellaneous item deduction, they add a deduction for unreimbursed employee expenses for eligible educator to the list of itemized deduction under Section 67B. So, basically, when you open up Schedule A, you open up the Schedule A form. When you file 2026 tax return, you're going to see a new line item. It is called unreimbursed educator expense. So eligible educator includes, hear me, that include K-12 teachers, instructors, counselors, interscholastic sports administrator. What is that? If you are, and you know what I'm talking about, right? Coaches, principals, and aides in school for at least 900 hours. Okay? 900 hours. Basically, this gives you a threshold. You may be a coach, but you didn't spend 900 hours and more. Then you don't qualify for this. This gives you a numerical threshold. The deduction is available for equipment and supplementary materials eligible educators use as part of the instructional activity. The provision applies to tax year 2026. Right? So that includes the stuff you buy. It is a good one. But what does that mean when they stay in Schedule A? That means that your expenses or your other stuff in Schedule A has to be bigger than standard number. Otherwise, it's not worth of even counting it, right? So you want to make sure that, are you going to have more than $31,500 merit file jointly standard deduction amount? Maybe you would, because now we also have another changes is right here. So this one is also coming in, and this one is actually not a permanent. It's for till up to 2030. So basically increases the, there is a section on Schedule A called State Local Tax section. And in that section, remember during the Job Act time, they eliminated that. Doesn't matter how much state taxes you pay. Even if you paid $60,000 on state tax, you can only deduct $10,000. Even if your property tax is like $25,000, you can only deduct $10,000, right? You remember that one. So that one right now expires, for the Job Act expires this year. So if we don't do any fix, we'll go back to what we had before, which is a lot more beneficial to the state that pays state taxes. Okay? So now this new act increased the cap to 40,000 merit file jointly, 20,000 for merit file separately. So again, everything we see here is trying to eliminating marriage penalty. So whether you are filing separately or you are single is half of the married amount. So it's a $40,000 for married file jointly, and for 2025 to 2029. What do I say here? So this year, when you file your 2025 tax return, even though the educator stuff didn't come in, but you already be able to have 40,000 deducted instead of just 10. 40,000 deducted, that is already over the 30,500 standard deduction. So by default, you're gonna be itemizer. You're gonna itemize your deduction, right? So if you're itemize your deduction, you don't care about the charitable donation, the 2,000 that you can put in before AGI, and you just bring them to Schedule A because they're all gonna add up, right? So with that said, then your Schedule A, a lot more people in 2025 will be able to itemize deduct because their state taxes, their property tax add together, it is going to be a lot more than 31,500. Now, there is no change to pass-through entity tax. This is very important to small business owners who has S corporation or LLC. You got K1 from 1065, K1 from 1120S, and you are concerned about that. Oh wow, this one changes. So what happened to my pass-through entity tax deduction rules? Many states, like Iowa, Minnesota, many states offered workaround for this 10,000 threshold introduced by the Job Act. They offered worked around and allowing business to pay state taxes at the entity level and deduct them fully at the federal level, and this provision continue to be available, which means that this particular act did not touch the pass-through entity tax deduction. So reassuring, but you are looking at 2025, that section to be a lot more. Continue on Schedule A, a lot of changes on this. Home mortgage interest. Remember we had home mortgage interest limitations by Job Act that came in, limit to interest on 750,000 mortgage on a primary and secondary home, right? No deduction for interest related to home equity loan. But here I want to add, if you're a small business owner, you did a home equity loan because you want to fund your business expansion, make sure you deduct that interest expense in your business, not on Schedule A, right? So this one, the new act made it permanent, so we still have the same limitation. And I know the software company who designed the tax software, they're getting better in terms of giving warnings to the tax preparer saying that, oh, your interest is over 750,000 and that would be eliminated. So, in the first year, I remember the software, a lot of software, very reputable software, just didn't even catch that. They just didn't really set that. If they don't set those kind of threshold, people who understand the act and did a study, did webinars, we know, but there's a lot of small outlets and people or community help people and they would not know. And those software really is one of the gatekeeper to make sure that the tax filing is going to be accurate. All right, then more related to Schedule A, then limitation on wagering losses. So how you have the gambling losses, and if you are doing the slot machine, I believe that is called wagering losses. I really don't, English is my second language, believe me. If my own behavior doesn't go to that place, I literally don't understand those terms, like medical terms, I'm pretty healthy, so I don't really go to see doctors like crazy. So I don't understand doctors' terms either. So that's my drawback, I'm telling you. And so this one, I believe it is the gambling losses. Basically, what they're saying is that if you do the slot machine, you win $100,000, but you say, oh, I lost $200,000. So the deduction for the losses can only be 90% of that $200,000. So they did that change, and no more moving expenses deduction. Just forget about that. And if you really move for your jobs, and ask your employer to reimburse you, so your employer can deduct that from as a business expense, right? In our firm, we do that, so I believe everybody is doing that. And remittance transfer tax 1%. This is new. This is like a new tax that imposed on behaviors. And what is that behavior is when you wire money and to Mexico and to support your family, and the financial institution who wires it for you, they are taxed for 1%. So they have to submit that 1% to the government. This 1%, I believe, will become your expense. So I don't know for sure yet. I don't know whether the law says can or cannot pass on to the consumer. I don't think the law will say cannot. So it all gonna pass down to you. If you wire money to China and you wire 1,000, then just make sure you pay $10, right? So that's the cost. That's the 1%. So no casualty losses from federally or some state-declared disasters. You know, in the FEMA declaration for the disasters. So you lost a lot of things, and you put that on your Schedule A as casualty losses. No, this act said that no, and you don't do that. So I guess only for the federally and the state-declared disasters. But if your restaurant happen to be flooded and you lost a bunch of things, your business can deduct. If it is your house and got into robberies and lost a bunch of money, that's casualty loss. If you have the police report and everything, and you can claim that, but not for the federally and the state declared disasters. You know, my thought behind that is that maybe I never really experienced that, so I don't know mechanically how the victim received money. So I believe that there are money to the victim already, so they don't want you to claim it under Schedule A. So that is kind of, in a nutshell, that is all related Schedule A. See, we talk about the rate, we talk about standard deduction, and we got a whole bunch of things, cramped through. Those are all Schedule A related items. And the one thing I did not mention, which really has a very deep impact on your tax filing, it is actually medical insurance related premium tax credit. And that one I did not really go in because, in my own opinion, we need to see how the insurance company react and the changes their bearings related to Medicaid, this kind of cancellation, the law changes on that side. That will affect your rate, affect your credit and calculation. All of that will come through, landed on individual, on your body. It will land on you at some point of time, but right now it's too early to really give you a roadmap. It is still in the infancy. The spirit, the regulation, the law is in place, but interpretations all the way from regulators to the insurance carriers, from insurance carriers to the agent, from agent to the business owner who bought the insurance, or to individual who has the insurance on the open market, will be all affected. So that part, and let's save it for later. Once we got into once we understand the rope, and we will explain that to you. So for right now, I did not touch on that piece in here because Schedule A also have a section where you deduct medical related expense, remember? So I didn't really touch that one. All right, child tax credit. Child tax credit, and everyone cares about this as long as you have a child. So let's understand what is existing ones for right now. So the child tax credit on the Job Act, they are temporarily modify the child tax credit, increase the credit amount to $2,000 per qualifying child. Increase the refundable portion of the credit to $1,400. What is refundable? Refundable credit means that child tax credit come in two parts. Okay? If you paid taxes, you get more. Let's say that $1,400 is what you got even though you don't pay any taxes, because you only have refundable portion available because you don't pay taxes, so you don't have that $600. Make sense? So, but the Job Act already increased the refundable portion to $1,400. Okay, of course, is subject to to inflation adjustment every year. So in 2025, this year, by Job Act, that $1,400 is $1,700. So even if you don't pay taxes, you're a single mother with no jobs and you have kids credit for $1,700 because that's refundable. Okay, and the Job Act also decreased the earned income threshold at which the taxpayer may qualify to claim the credit. They decreased it to $2,500, which means that, you don't have to, your earned income threshold, it will be, you qualify for that deduction at $2,500. The increase of this threshold amount, will begin to phase out because you make more and more. So they will say that, okay, and if you make more than $2,500, and it start to phase out, right, to up to $400,000 for a joint couple. So that is where, by increasing that, it just means more and more people would get more full tax credit, right? So the refundable is increased, and they got, they also can get more, more people would qualify for the refundable tax credit. And it requires this new job, the Job Act requires the taxpayer to include the qualifying child Social Security number issued on or before the due date of the tax return. On the return. So basically, if you say that, oh, I have a child but just don't have a Social Security number, and you need to include that on the tax return, and you need to get that number before the due date of the return. Of course, if you file an extension, the due date will be October 15, right? So that is the old act. So the new one made all the Job Act changes to be permanent. So they endorsed it, but they had a following adjustment. Number one, the non-refundable child tax credit amount to increase to $2,200 per qualifying child. Okay, so they're talking about the they're talking about the 2025 right now. So remember this one, if you look at the earlier in 2025 under Job Act is $1,700. So now they're saying it's $2,200 per qualifying child. So they give you more refund, right? Even if you don't pay any taxes, you will get more child tax credit. So that sounds good. So you got more child tax credit. And in there is also indexed the inflation to 2024, not 2017. So that is something behind the scene. You don't need to really bother, and just knowing that the government trying to be very reasonable and accurate, right? Also, to claim the credit, this is a modification. The taxpayer is required to include on the return both the taxpayer's Social Security number, or for a joint return, the Social Security number of at least one person, one spouse, and the qualifying child Social Security number. So the qualifying Social Security number for these purposes is a Social Security number issued by Social Security Administration to a U.S. citizen or naturalized U.S. citizen, or some provision that related to lawful admission of employment in U.S. So basically, Social Security number. You must have a social security number, both the mom and dad and the child. The mom and dad, it says that one of you. So if another one is 18, assume it will be okay, right? In what they say here. So a lot of times you discover that when you start running your taxes. So you got a mom with TIN number and dad with social security number. You have a kid born here in U.S. has social security number timely, and then you run your taxes. You go, oh, I don't see the child tax credit. And then that's when you need to work on the programming. Maybe the programmer forgot about the amendment number 3 because it only require one of the parents to have a social security number. All right, so now I want to mention this to you. So let's say if you made a mistake, if you made a mistake and you put in the wrong number. So normally what IRS does is IRS can open up audit you, determine you're not eligible because your number is not a real social security number, and then deny you, right? Now this act has one spirit. It goes everywhere I see. Basically, they are treating that as a mathematical error you made on the return. So they deny your credit without issue any investigation, any audit to you. It's just a letter of adjustment that comes to you. And you know that IRS do that, right? They issue letter of adjustment. Oh, you forgot to report interest income. They see it, so they put that on for you, and you pay additional tax. So in this case, if you have a child and with the IT number, they don't qualify, but you put in the social security number. The system ring it out, goes, that's wrong, not a number. They're not going to investigate or anything whatsoever. The system just denied that credit. That's it. So that's what they mean by treating that as a mathematical error. So they are treating all of these related to social security number, IT number, or misused social security number whatsoever as mathematical error. All right, extended credit for other dependent. I call that mother-in-law credit. Okay, very important. So the credit for other dependent, not your child, is mother-in-law credit. The Job Act provides a temporary $500 non-refundable credit for dependents who don't qualify for child tax credit, and that includes the child over 17 years old, right? And the child without social security number or qualified dependent who aren't children, they're mom and dad, mother-in-laws, right? The credit is available for dependents who are U.S. citizens, U.S. nationals, or U.S. residents, aliens, who has either a social security number or IT number. Got it? Okay. The credit for other dependent phrase out for AGI, 400,000. 400,000 joint return, that's kind of a magical number. It is still that way. So I want you to know that if you are individual and you got so earful of everything, you don't want to listen to Ying talk about anything, you just want to know one number and saying that I want to know when do I need to perk up my ear and listen to the planning folks and do some planning on my taxes. That magic number is $400,000 for joint couple, $200,000 for individual. So the new act make the credit for mother-in-law permanent. So you got the $500, okay? And the omission of correct social security number on the return is treated as a mathematical error. It's really not going to send you a big red flag, tell you that, oh, you're fraudulent. They're just not going to give to you. And they're not going to do any, judgment on you, and they just change it for you, and you get a little letter of change, that's it. Okay, enhanced child dependent care credit. So before, during the Job Act or before the Job Act, the taxpayer with one or more children, can claim credit for expenses that paid to the daycare or to the individual or to the household employee people, right? You can include those expenses. The credit is calculated by multiplying the amount of qualifying expenses and maximum to $3,000, but it is like roughly 35% of that. So, but if it is over $3,000, no, stay $3,000. If it is more than one child, it's $6,000. That's the child tax credit, right? So the new act increased the maximum credit the calculation to 50%. So you're going to be reaching the 3,000 a lot faster. But 3,000 stays, and so that way you actually calculating it a lot faster is 50, not 35%. The AGI between 43K and 75K, in the case of joint return, the credit rate is 35%. So this credit rate, the 35% go down to 25% with your AGI level going up, right? So you want to know that, of course, the income level is one thing. So they're saying that, well, you got 35% at this 4370 AGI bracket, and before that, you got 50%. So it's like giving low-income individual a lot more help on the dependent care credit. The provision is effective for tax year after 2025. So it goes into 2026, but permanent. Here, this is Trump accounts. It's brand new concept and still need a lot of development. But the idea is you can put in, allow new tax favored accounts to be established on behalf of your children. So that's why I put it along the child stuff. So you have child tax credit and child care tax credit. And then now here you have this Trump account is also designed for your child. So you can receive, and the child can receive contribution from parents, relatives, employers, and other taxable entities, as well as non-profit and the government entities. To be eligible for an account, the child must be U.S. citizen, have Social Security number. So this one didn't mention ITIN, right? A lot of children have ITIN numbers, and they can't open Trump account. Trump account is only for American, right? And structured like IRA with fund distributable after the child turned 18 years old. It capped on $5,000 per year. So make sure that you perk up your ear, listen to this more, see how that comes through, right? So this is this is available to children born in This is available from 2025 through 2028. It's a temporary thing, so it's not permanent. Then they are also creating a pilot program for government-funded initial 1,000 contribution for newborn from 2025. I don't know whether they have to be born after January the 20th. Remember, the inauguration date for President Trump was January the 20th, so some tax provision was actually cut off at that time. If you were born before January 20th, you're not eligible. But it didn't really say any of the details. So right now we just know that, and the parents can have tax deduction, tax credit for these account up to $5,000 per year on contribution from individual contribution. You put in $5,000, you get up to $1,000 tax credit. So that's kind of what that is. And we'll hear more, and we'll talk about this in details, how to set up. I would imagine this would be part of the financial planner's work, and they would know to get that set up and to invest it. And there's also regulation related to this money, how they can invest. So it is definitely the financial planner's job. But you want to know as parents, right? So you can enjoy that tax credit. All right, there is an enhanced deduction for seniors. So right over here, and I want to say this to you. You know how I am not financial planner, right? So I have clients are planning to convert IRA to traditional IRA to Roth IRA. So they want to pay taxes right now. So when the value grow in the Roth IRA, they don't pay taxes in the future. So I just want to add a comment right here is that the tax is being manipulated by different administration actively. Just like how there are people celebrating this one big beautiful bill because they're paying less taxes. So the contrary could happen too, right? So another president come on board and it will reverse all of these and do something else. So taxes, the tax rules and laws and regulations, it is something the White House residents has the power to change. So when we plan the future, if someone tells you, oh, you're going to save taxes in the future, I hear that with grain of salt. And I will not just blindly believe, because you can see that there's a lot of states are putting in efforts to not tax seniors. Here you see the federal government is making its step to reduce senior taxes. So what does that mean to you? That means when you were young, you paid a lot of taxes because you think you're going to pay more taxes when you are seniors. Wrong. You pay less taxes. So with that, don't try to do extreme things. And if you are active, making a lot of money today, save money today, don't try to convert. And I know financial planners say different things. I'm not financial planner. I'm not licensed for that. But I understand taxes. So I always very careful with that to say what that's really true or not. So the new act says that taxpayer aged 65 or older and their spouse, and if filing jointly, can claim $6,000 deduction, pre-qualified individual for tax years beginning 2025. So this year, 2025. The senior deduction is reduced by 6% for the adjusted gross income that exceeds $75,000. So if it is not exceeding $75,000, forget about the 6%, right? So you have the $6,000. But if you exceed $75,000, that $6,000 will be proportionally reduced. To claim deduction, the taxpayer must include the qualifying individual's social security number on the return. Okay? The law treats the mistake, treat the mistake on the social security number as omission, and a correct social security number for the senior deduction must be presented. If not, it is mathematical error, clerical error, so allow IRS to disallow the deduction without formal audit. So straightforward, simple, and less overhead. They're just gonna check your social security number, goes, that doesn't look like yours, then you don't get the deduction. All right, so that is an enhanced deduction for seniors. Starting from 2025, ends in 2028, temporary. Tips income. So there is no talk about tips income, but this new act created above the line deduction up to $25,000 to be eligible for tax deduction for qualified tip income. Individual must provide a work-eligible social security number for themselves. If married, must file joint federal tax return. Payroll taxes still apply. Okay? If your income is so high, $300,000 jointly, then it disappears, right? So this is temporary, 2025 to 2028. So what do you expect from here? So we have a lot of business owners are listening to this webinar today. So let me tell you, you own a restaurant, you have the tips. So there are also businesses, they receive tips, but you don't qualify for this. This is only for the tips, are eligible tips for the industry. So restaurant for sure qualifies. If you have a restaurant, so now you want your, if you have your employees and, claiming tips, how they would report tips to you, right? So you still pay Social Security, Medicare on that. You still get tips credit from the back end on your tax return, but your employee reporting tips, and they can be comfortable that to know up to $25,000, they won't pay taxes if their household income is under $300,000. All right, so quite a bit help to people who survives on tips. All right, what else? Overtime. okay? This overtime is new too. It says that we will give you above line deduction of 25,000, and but you can put your your overtime pay on that cell, so it will get you free from income tax. So of course the payroll tax still applies, because you as a business owner, you run the payroll for them. You already paid Social Security, Medicare match, and they already paid Social Security, Medicare, the other 50%, right? And if your employee makes too much money on the joint return, they don't have that. They lose some of that, or they just totally don't have that. But otherwise, they can reduce their taxes. So this is temporary, again, 2025 to 2028. And it's on overtime. So the real practice tips I would give you is in the restaurant. In the restaurant business, you should really paying people hourly. Like Department of Labor is very big at auditing Fair Labor Act. They want to make sure that you pay the chef on the hourly rate and paying overtime, right? A lot of times, our business owners knows that the chef need to work for 45 hours a week. So they already know there's a 5 hours extra overtime, but they give them a one lump sum pay. Then DOL come around, goes, well, I don't think you calculated overtime pay, so you still owe 2.5 hours to your kitchen chef, right? Because they think that your 45 hours pay, you already calculated overtime, is part of their base pay. So now, with this rule, business owners, restaurant owners, you have a way, you have a good way to talk to your chef and tell them that, you know what, I'll start giving you the hourly rate. It doesn't change your pay, so you still get the same number, but the overtime I identified for you, when you file your taxes, you don't need to pay taxes. Of course, assume your joint return is under $300,000. So with that, you see, they would be more willing to get your paycheck broken down with 40 hours regular pay, 5 hours overtime. And for employer and for restaurant owner, you are much more close to the requirement of the government imposed on you. And a lot of times our small business owners don't want the trouble. They don't want to think about it. But your payroll processor can help you break that down, and making the difference between the overtime or not overtime. Then your employee will save money, right? Overtime pay. No tax on car loan interest. This one is also new. And in the past, from the Job Act, the individual can deduct up to $10,000 only on interest expense, right? On interest expense per year. So it's subject to the phase out, and $100,000 for the couple, and $100,000 for individual, and $200,000 for the couple. But the car loan deduction right now we put on the act is starting from 2025. So if in this year you go buy a car and used for personal use, it's not for business, folks. It's for personal use. So you would be able to get a $100,000 car loan interest deduction, right? So the qualifying factor is, number one, you must buy that vehicle in 2025. This is also temporary, right? From 2025 to 2028. Number two, the vehicle must be a car, okay? I don't know. Is the English word of vehicle include things are not car? I don't know. But the act says that the vehicle must be a car, minivan, van, SUV, pickup truck, and a motorcycle with a gross vehicle weight under 14,000. And I know people talk about 6,000. That's business related. I'm talking about personal vehicle. Okay, so the taxpayer must report vehicle identification number, VIN number, on the return. In addition, the provision requires the lender to file information return with the IRS. Means that you're going to be receiving a 1098 interest like how you receive your mortgage and for the car loan. And it's $10,000 car loan interest deduction per year. Okay? So you would never get there, wouldn't you? $10,000? Are you kidding me? You're going to have that much car interest to pay per year? That's a lot. I guess, people buy more expensive car, right? Who knows? Maybe their car is $1 million, All right. So that is the no car loan. And then my last one, okay? My last one in this list is related to the basic exclusion amount. What that is related to death tax, related to estate tax. And when a person dies, whatever that person owns would subject to tax if it is more than a certain amount, right? So the U.S. citizens and residents are allowed a unified credit of the applicable credit amount against any estate and gift tax imposed on the transfer during life or at death. So basically, if mom and dad has a certain amount of money and they can transfer to the children, or they can die and go through the life and transfer to the child. So before Job Act, the basic exclusion amount was $5 million before. So the Job Act came and increased to 10, but you can imagine that if we end by 2025, we go back to the 5 million, right? I know right now the 10 million already in 2025 is already went up. So it's adjusted for inflation. So this new act, after December 31st, 2025, the basic exclusion amount will increase to 15 million. So in 2025 is 13.99 million. Because that is already adjusted to inflation from 10 million to 13.99. But right now, for 2026 coming, it will be 15 million, and it will adjust to inflation. So I want to mention that because a lot of our folks, if you knew your wealth add up today already over 13.99 million, and will be over 15 million, adjusted with inflation in the future, then you are the one needing to do estate planning. But if you are not there, say, oh, I don't have that money, I'm 3 million, 4 million, then what you do is not estate planning. What you need to do is asset protection. Estate planning, asset protection is not exactly equal. It is approximately related, but not equal. So if you don't need to worry about your wealth because you are way under 13.99 million, then you have issues. You're worried about your asset. You're doing asset protection. But if you are over that amount already, I know clients already for sure, then they need to do both, right? Asset protection and also estate planning. All right, so that is about today, and I am not sure the time side. Oh my God, I'm running out of time. So let's just say that this is our partners, and you can contact us, folks. I apologize for running out of time, but I'm glad that you're still with me, and I have a office number here to give you, 515-288-3188. Magical number. You call Monday to Saturday. We have a real person answer your call. And in our office, we do not allow dropped calls. So if you call, someone will answer. But of course, we have Sunday as a day we close the office. But other than that, 6 days a week, we're open. So you can call us, and you can also email Catherine at communitycpa.com to tell her what you want me to talk about. And I will see you again on Tuesday. This next few webinars is all going to be focused on one big, beautiful bill act. So we'll eat it, we'll drink it, we'll digest it, and we'll make it the human waste at the end.